Namaste and welcome to another episode of A Questioning Mind. I'm your host Sagarika, and today we have Mohal Joshi with us, who's been on the podcast before. He's the co-host of India Rising podcast, which he co-hosts with Kishore Narayan and discusses geopolitics, current affairs, and economics. Mohal, a very warm welcome to the channel again.
Hey, Sarik, it's a pleasure to be on the podcast again.
So Mohal is quite an expert on the subject of economics, and considering that the U.S. has seen three major banks collapse in a very short while, I wanted to kind of get to the bottom of it for the viewers, and hopefully you also are interested in something like this. If so, do drop some comments as we go on, and I'm sure Mohal and I will answer as many of the comments as we can as well. So, Mohal has a lot of experience in the field, which is why he comes with quite some expertise when discussing this. We'll be breaking it down with a discussion of some of the more common terminology. So, even when you read material outside of this podcast, you will be able to understand the subject better. But again, do feel free to drop any questions you may have in the comment section below. All right, Mohal, let's begin. SVB, which is Silicon Valley Bank, Signature Bank, and First Republic Bank, are three of the major American banks that have collapsed in a matter of a few weeks. This is almost unprecedented, and it did bring in the fear of a 2008 repeat. So, what are your views on how close this is to the same to 2008?
Yeah, I mean, if you look at by the size of the banks, the three banks that you just referred, like Signature, I mean, and we have that nice bubble chart that I shared, Sagarika. If you can share that with the viewers. So by the capitalization, like we have the three of the top 30 banks,
Mhm.
and in the US which failed, Signature, First Republic, and Silicon Valley. I mean, if
Right.
you look at the overall size when they went down, they would be the second, the third, and the fourth largest bank failures in US history. The only failure which was bigger than this was Washington Mutual just before the global financial crisis. Now, um, it's not that like banks do fail in US. I mean, in US there are like over like 4,000 various kinds of banks, uh, including like all around 150 failed at the height of the Great Recession in like 2009, 10 thing. And even actually, surprisingly, many people don't know like over 500 banks have failed since 2001. So it's the last, you can say, like 22
Wow.
odd years. But what makes this kind of different from the other ones, and can you share that image again, because
Just
yeah.
so.
So what makes this kind of interesting is that the sheer volume of these three banks that have collapsed. So if you see like on the time scale, there was this huge cluster of banks that failed
Right.
around, let's say, 2009 and 10. Then there is not much happening, maybe one odd bank in the 2015 era, one in 2017, but then it's almost like a spotless record in terms of the size of the banks. And then you have these three major dots, which is kind of surprising because people would have thought that some of the recession during the, I mean, we had a brief recession during the pandemic would have caused major failures, but they are
Right.
starting to show up now in 2023 versus 2020. So yeah.
Yes, that was always interesting to me that during the pandemic, nothing like this happened, and right when we cross it, that this is when banks start to go down. So, what are some of the major reasons behind this?
So there are like a bunch of reasons. Like one is like the increasing of the interest, and I'll go over that in the podcast. But before that, I wanted to just cover a few banking terms, just so that the viewers are up to date on,
Sure.
like, because we'll be talking a little bit of, I
Yes.
mean, I would say
Yes.
like too complex but slightly complex terms for the average listener. So basically banks, I mean, most of the people think that, that's where you put your money away for safekeeping. But also what happens is that it's more than that, right? I mean, banks, you put your money, deposit your money at the bank, and they loan it out to, others. So like
Right.
that's part of the, as they call, the fractional banking system, where
Right.
like the loans are loaned out to other folks. So like the basically the bank has two things on its balance sheet. Like basically you have the assets and your liabilities. So the assets is basically your loans, your securities, and your cash reserves. uh, and Sorry, not the cash, I mean the reserves. And your liabilities are basically that the bank owes to someone else.
Mm.
So interestingly, when someone might think like intuitively that okay, I put money in the bank, it is my liability, because if the bank goes under, it the money goes under. But technically in finance terms, it's a liability of the bank, because the bank has taken the money from the depositor, so it has to return if and when the depositor asks for it back. So it's a liability for the bank. So, and there's also like bank could borrow from other institutions. So those are the assets and the liabilities. Now
Right.
banks usually operate on the mantra of like, borrow short and lend long. So if you can bring up that curve that you were sharing, like the yield curve. So what happens is as you go out further in duration, so let's say if you have 1 year, 2 year, 5 year, 10 year, as you in a normal economic cycle, the normal yield curve rises with time. So let's say if you have the shortest loan, then it would be at X. Let's say if you have a slightly longer loan, it should be Y, where Y is greater than X, and eventually it goes up to the maximum maturity level. That's what happens.
I think we'll have to go into bond maturity as well to explain this
Sure,
graph.
sure, sure. So, but the whole point is that the banks will borrow short and lend long. By borrow short, what I mean is like they might take a depositor. Let's say Sagarika, if you are giving money to, let's say, State Bank of India, for example. So State Bank of India will give you a certain amount for putting your deposit. Let's say we call it the savings rate. Let's say it is like, I'm just making up a number. Let's say like 5%, for example.
Sure.
But then the bank will go and want to give it, let's say, a 5 year, a 10 year, or a 20 year loan to some financial institution, or let's say a company. They might charge them, I'm just again making this number up, like let's say 8%. So the net interest is where the what the bank earns, because they can lend long and they can borrow short. So basically they are giving the depositor a smaller rate than what they give the person who takes out the loan. But
Sure.
in current situation, what has happened due to the impending economic slowdown, we are left with an inverted yield curve, where it creates a problem that they are getting squeezed, because they are they have to pay more money to the depositor, and their loans or what their assets are, they are paying them much lower rate. So this
So
is like a
yield is essentially the net difference between the interest earned from the depositor versus the
no no
lender.
no no no
Yeah.
not the yield itself, the net interest income. The yield is like what you are the loan, the person who takes the loan, how much he earns, sorry, how much he pays the bank from it.
Okay, so that's the net amount. That's the yield.
No, it's not the net amount. It's the actual amount. So there will
Yeah,
be
yeah.
two.
By net amount, I mean what came in without any
Yeah.
interest
What
or
either
just
the sorry I
the
get what
hard cash.
yeah. So what either the bank is paying the depositor, or what the loan taker is giving back to the bank. So basically, like whoever
Oh, right.
borrows the money is
Whatever
supposed
money
to.
is in the bank, we're calling it yield, and maturity is the time period. And over
Yeah,
time, we
yeah,
see
yeah.
that instead of going up, that's gone down.
Yeah,
So,
yeah.
yeah.
So with the what happens in prior to almost every recession in the last 30-40 years, the yield curve is inverted. So which creates a problem that uh, let's say take the reverse scenario of what I just described to you. If the deposit rate for your money, again, you Sagarika, you deposit money at the bank was 7%,
Mhm.
and if someone was taking out a 10-year loan and the far end of the maturity curve is at 5%, then technically the bank is losing money, because it has to pay you 7% while it's
Mm,
only earning. So the 7% is the liability, and the 5% the bank's
sure.
uh, the asset. So the asset is yielding less than the liability. So basically the net interest earned is negative, which is not a sustainable business
Okay.
model for the banks. So That's one thing. And then another thing I wanted to discuss, like before we get into the more nitty gritty details, is the bonds and the yields. So the bond is like basically a fixed income instrument, like where the holder receives a certain payment, uh, a certain coupon rate, where it is when it is issued. So let's say, like for example, let's say Apple, like Apple issues a bond, or it could be like even the US government. Let's take the US government. It's a 10-year, let's say it's 3%. So every biannually it pays like 3%. Let's say on a 10-year it pays 3% interest to whoever bought the bond from the US government. So uh the 3% is technically the yield, but what happens up is, like technically you could hold it to maturity and it would always be 3%, and the the bond coupon rate would not change. But what ends up happening is that the rates fluctuate. Like today it's 3%, tomorrow it can go to 4% or 2%, right? So what ends up happening is, and this is kind of slightly complex, like let's say if it goes to 4%, and if I want to sell the 3% coupon in the secondary market, I mean the bond, the problem is the next person is saying, hey, you know what, I'm getting a 4% coupon nowadays, why should I buy a 3% from you? So what I have to do is I have to sell it at the lower face value, which is called the bond price, to compensate for the lower interest, for the higher interest that's prevailing in the existing market. So I have to reduce the value of the my bond, and that way I have to take a basically a loss. But if
Yes,
the
right.
opposite happens, if it's a 3% and now it's only 2%, then my bond becomes attractive, because if the buyer of the bond, he will say, oh, I mean, he's saying, oh, my current, if I have to buy from the market, it's only 2%, right? But if you have a 3% bond, then it's yielding him more money, so he will pay me a premium, and the yield on the bond technically goes up. So that's what, like happens. It's kind of a complex calculation. I don't want to go into the details, and even I'm not
Sure.
very expert at it at all. But that's how the bonds and the yields thing. And one more thing is, like basically the a couple of like quick terms I'll quickly go through is like the bond duration. So what ends up happening is, like the process I described, where the bond yield price will go up or down, will also depend on how long the bond is. Because if it's a shorter bond, technically you would be, let's say if the bond price, if the interest rate went up, the bond yield goes down, but it's only you're getting paid as a net difference for a shorter period of time, so the delta is small. But if it was over a 10 period versus 1 year, it means that you are getting lesser payment over a continuous uh, 9 more years than the other bond. So it has to be discounted, or the value has to be much lower than the other bond. So what ends up happening is something called a bond duration, which says that uh, that the bond duration is basically like how much percentage the value of the bond decreases if the interest rate changes by 1%. So if it's a bond duration of 5, it means for a 1% change in interest rate, the overall value of the bond uh, will go down by 5%, for example. So these are the basic terms. I mean, I'll skip over for some of the one, and I'll discuss them as we go along in the podcast.
Sure, sure.
So coming to like Silicon Valley Bank. So what happened with Silicon Valley Bank? So Silicon Valley Bank was a banker to the Silicon Valley Bay Area startup. It was a California-based bank. It captured a lot of the the venture funds out
Absolutely.
on the West Coast. Now, what ended up happening is, as this graph shows, that there was a massive increase in the deposits from like around, I believe, like 60 billion to I think 173 billion by the end of 2022. So there was a massive growth in the asset. I mean, like as you know, during the 2020, and as why didn't any banks fail? Because at the around the third week of March, like the Federal Reserve started. I think they printed like almost like 3 trillion of dollars over the next few months, and they injected a massive amount of liquidity in all kinds of stimulus, QE,
Exactly.
Right.
an interest.
I actually had to. I wanted to ask how much did the is liquidity in the market affect the bank crisis?
Yeah, so I mean, technically, uh, there was a crisis back then. So to shore up, I mean, they just injected a massive amount of liquidity because what had ended up happening is everybody was trying to rush for U.S. treasuries. I mean, basically rushing to the safety of the U.S. dollar, or the
Right.
U.S. treasuries, basically. So, and then the market had frozen, so they wanted to stabilize the market. So I think they ended up like putting in like I think there's a good book by Nick Timmerus of Wall Street Journal. It's called Trillion
Yeah.
Dollar Triage. I mean, it's in the name. I mean,
Cool.
it's like $1 trillion. So it's I mean, I have read parts of it. I haven't gone through the whole part, but I think that's one of in my to do reading list. $1 trillion Triage.
Got it.
Anyways, getting back to us, like, so what ended up happening was a lot of funds flew in. Uh, to Silicon Valley Bank during the 2020. Now, what the bank's business model was, basically they wanted, like, to attract a lot of this VC crowd. So what they would say is, hey, you know what? Why don't you deposit the money at our bank, and we will give you like special perks. We'll give you like special financing, will give you low cost loans. So what ended up happening is many of these VC founders, they park their capital at SVB to get this secondary or ancillary benefits. Now what ended up happening is that a lot of these people, they deposited a lot of money, a high amount value. Now, as you know, the FDIC, or the Federal Deposit Insurance Corporation, only uh, covers the balance is covered up to 250K. So anything about 250K in theory is not covered by the insurance. So what ended up happening was that around as per the last reports, like around 93% of the deposits were uninsured, and they are like very prone to capital. I mean, if I say that, okay, you have 1 million and like only 250 of it is covered, then you are obviously, you will get very jittery that the moment you hear any bad news, that let me get it out, because I might be just ended up with 250K. So
Mm.
I mean, and this was the highest percentage in the nation of uninsured deposits. And also similarly, even federal sorry, First Republic had a similar issue, where a lot of these VC crowd, high dollar amounts, usually, like, say, a bank will have a mixture of deposits from, let's say, engineers, contractors, businessmen, VC crowd, teachers, doctors, firefighters. So it will be like a lot of a mix, and many people might not keep more than 250K in the bank, but like many of these tech uh, Bay Area folks, they kept a lot of this. So they were very prone to moving their money at the first sign of trouble. And then in also another thing was, like, First Republic, for example, made 60 billion in loans of interest only loans. I mean, we thought after the global financial crisis, like, interest only loans would never be made, but they were just giving sweetheart deals to all the high net individuals or high net worth HNIs, because they wanted to attract the deposits. Like, hey, you know what, we'll give you a loan. I mean, imagine if you are a millionaire and if you want to buy a second home, and if somebody's giving you a no interest loan, so let's say for the first 10 years you have to pay no interest. Sorry, you're just uh, you don't have any um, like, 0% interest on the first 10 years of your loan. Then obviously
Mm.
you're going to, like, let's say in 10 years, let's say your property value doubles, and you can, sell it, and you could have no recurring interest charges over the 10 years, right? So
Right.
you're just trying to attract a lot of these high interest, high net worth individuals to the bank, but that created a lot of kind, I would say, like, risk, but like, homogeneous kind of deposits at the bank versus the heterogeneous kind. That in the homogeneous, like, they are all prone to escape at the same time, because they run in the same circles and they would talk to each other, and they're all uninsured. That is the biggest thing, right? If you're insured, obviously, you would still worry that if it's 250K or not, but when you're uninsured, it is prone to, at the first moment of trouble, you just like run away. Now, coming back to so basically what happened is, like, all this money piled into, I mean, there were these new startup ideas, a lot of this money, stimulus money went to got flowed into like the tech companies and the VC crowd. So they
Mm.
put the money in the Silicon Valley. Now, the technically the Silicon Valley had tons of cash, right? I mean, the deposit base grew by tripled. So they
Right.
had to put it somewhere, right? I mean, they can't just leave it as cash, right? Because they won't earn anything in there. So what they did was they bought lot of long dated treasuries, like federal treasuries. So they thought, US government is not going to default. I mean, they were getting like 1.5% on a 10-year treasury back then. So they said, let's pile all of this into treasuries, and we'll be safe. I mean, it's a government. They also bought some mortgage backed
So
securities.
I just want to kind of focus on the point that they did this based on trusting the government that the rate would not change, that the rate would not be hiked by the Fed, because they were paying the maximum interest that they could pay, which would help their lenders, sorry, their depositors. So that was, and they kind of put all of their eggs in that one basket in government treasury bonds, which is not a good idea for pretty much any bank to do.
No, I mean, they can put it, but the proportion they put is was kind of, and I'll come to
Exactly.
that
Like
point
you
later.
can't put
You can
all
put,
your eggs in that one
yeah, I mean, they
basket.
didn't put all their eggs, but they put a large proportion, like maybe the highest proportion of all the banks. But what ended up happening is, like, see, back then in 2020, like, we were in recession, so stimulus was required. But what ended up happening is, like, as you rightly said, the even the Fed at that time, I mean, the Fed chair Jerome Powell said, like, we are not thinking about raising interest rates. So I mean,
Mm.
the special emphasis on saying thinking, the word thinking twice. I didn't
So
make a
wise.
mistake.
Right.
So
Yeah.
and then, like, see, this was a since the global financial crisis, except a brief period between 2016-19, interest rates were zero. So they were in this called
Right.
ZIRP or ZIRP, basically zero interest rate policy. So they were used to this. So they never thought that, oh, interest rates might go to 5% at some day. So they were accustomed for, like, they have been or maybe lulled to death, or whatever you want to call it, like, with this 0% interest rate environment. Anyways, so they put I think, like, almost like over 100 billion in, like, this treasuries. Now, what ended up happening was that, as the Fed started to erase interest rates, and there was economic slowdown, so all of these folks, like the tech companies, like, okay, maybe they needed more cash because they're burning out, so they started to withdraw money. So they started to withdraw the money from the Silicon Valley Bank. So eventually, the Silicon Valley Bank, since they had piled so much of the money into long-term treasuries, they only had a limited capital. Now, on March 8th, basically they announced that they were selling their treasuries. And also, okay, so now coming back to that bond thing, like, when they bought the treasuries, like, they were like around, let's say, 1.5% on an average, and now interest rates were like 4 to 5%. So if you, and they had also a long duration, so they bought really long treasuries. So the convexity of the duration hurts you, because the longer you have the delta spread, the more your bond portfolio will go down. So they sold 21 billion in securities, and they took a 1.8 billion dollar uh, tax sorry, loss. So everybody got spooked, like, what is happening, like, why did they have to, and then also they tried to raise some capitals by issuing new shares, but which also failed. So this is like when all hell break loose and, like, panic set in. So many VC funds, tech funds are like, hey, get your deposits out, this gone thing is gonna fail. Now, it's not like it was going to fail right then and there, but I mean, as somebody compared, like, it's like, yelling fire in a crowded theater. It's like basically like a self proof
So
uh
I just want
thing
to
protesting.
confirm that had they not panic withdrawn all of the funds, uh, the bank was not going to necessarily be in trouble. Is that
Yeah, yeah. So on the March 9th, I believe that was the Thursday, 42 billion flew out of the bank in terms of customer withdrawals. And on Friday, the FDIC took over the receivership of the bank, because, like, they were basically insolvent. So as per some reports, another 100 billion was slated to flow out of it on Saturday. So over the 2 days, 9th and 10th, 142 billion. And just keep in mind, they had like around 173 billion kind of assets by the end of 2022. So basically 80% of your
Right.
assets would just like go out days. So it was like a massive amount of panic. It was just like everybody just wanted to, and like, see, that is the thing, like the 93% of depositors did not have their money safe, right? So they would be prone to, and they were all in the same tech VC crowd, a lot of it. So it just created a huge panic that everybody just wanted to withdraw the money. And in 2 days, 80% of the deposits were going to fly out. So I mean, there was no way they would meet all these obligations. So SVB was shut down on March 10th by the regulators.
Mm-hmm. Got it. So a lot of it was panic. A lot of it was a very natural thing for a bank to not have as much cash on hand, during a panic withdrawal. There was not something necessarily already wrong with the bank and its system at that point, but the chatter around it and the overdependence on the Fed to not raise their rates was the key issue here. Um,
Yeah, I mean, there was also a lot of risk management, which is like questionable by Silicon Valley Bank. I mean, all banks had
yeah,
bought
let's do that
treasuries.
because it's not. It seems like the focus on a single point with a rate hike is not going to give a complete picture. So, what were the other regulatory issues
Yeah,
that
so there were
bank?
quite a bit of it. So I'll cover them one by one. So first of all, like SVB had kind of lot of red flags. So first of all, the Silicon Valley Bank had no CRO, which is the chief risk officer, for 8 months between like summer of 2021 and sorry, summer of 2022 to January of 2023. This is like when all the interest rates were being hiked. So like having no chief risk officer is kind of crazy. I mean, there was too concentrated in like one industry and area. Like, I mean, let's say if you take a JP Morgan or a Chase, they have a very diversified portfolio base. So let's say if you have a slowdown in, let's say, I mean, if you have a global financial crisis or COVID like this, obviously hit to every industry. But let's say in a normal slowdown, if one tech sector is like slow down, everything else doesn't slow down. So you don't have
Right.
everybody pulling your money out or everybody in risk, but only like one sector. So it was not diversified enough. And the downturn in the technology and the California businesses extended to, I mean, it led to the, it doomed basically the Silicon Valley and the FRC banks in California. Now coming to the internal risk management, so like as per like a article in Washington Post, so basically they had internal models which showing that higher interest rates would have a devastating impact on the bank's future earnings. But instead of heeding the warning, the report says that SVB executives simply changed the model's assumptions just so that they would be I mean, like they would be like uh, changed. I mean, if you change the model's assumptions, I mean, obviously, you're not going to get a bad outcome. Also, I mean, a lot of people have criticized them for not hedging the interest rate risk. Now, the thing is that I mean, so in the bond portfolio, there are at least two sections. Okay, there is the held to maturity and the available for sale. So the held to maturity, you technically cannot hedge it. The available for sale portfolio, you can hedge it. But technically, I mean, you can only hedge a certain part of it. You can, if you just hedge all your portfolio, then it means that you are just like not doing a good trade because you'll
Not
be spending. So you can hedge a part of it. But the interesting thing is that SVB had done some hedging and they sold it last fall because they were making a good profit on it. And which is kind of crazy that like and they thought, oh, the Fed is done with the interest rate, right, they will not go even higher. And so the one instrument they had to like kind of help them against it, like they just had no hedging, which is kind of crazy. Like, so the day they collapsed, they had absolutely no hedging against interest rate risk. Now in kind of hedging is basically I don't want to go to the details, but basically you get a small payment from the other counterparty if the interest rates go up. That's basically hedging. So you earn some amount of money even though your bond portfolio
Right.
goes down. You earn some money because of interest rate swap or whatever what's it called. Anyways, so another official report said that the executives, whenever they were presented with these models, that what would be the risk of interest, if they didn't like a model, they would just scrap it and change it. I mean,
That's a massive risk for the depositors, but it's also it's it's wrong.
yeah, I
It's
mean, it's not, I
unethical.
mean,
It's
and also this report says in late 2020 the firm's asset liability committee, okay, so like the guys who should be on point for this, the internal recommendation was to buy short-term bonds as more deposits flowed in, because as I said, a shift in the interest rate, in the shorter you get, you have a smaller delta, because you are only getting paid a difference for us versus the current rate. In a longer rate, the difference becomes larger because you get the paid more. So the shorter interest rates, I mean, the shorter term treasuries would have earned them, would have given them less pain. But what they were looking is like, but the report says, but if they had gone into shorter term bonds, their earnings would have been hit by around 18 to 36 million. So obviously the executive steered them towards the longer dated bonds, but ended up creating a larger risk because they wanted more profit. I mean, in theory, their profit did jump like by 50% in 2021, and the firm's valuation was like 40 billion. But as the interest rates went up, eventually they got, I mean, hit. I mean, so as per the report, it says that SVB's portfolio, with all this uh, available for sale and held to maturity bonds, was like 57% of its total assets, and
hmm,
the next biggest US bank for comparison had only 43%, sorry, 42%. So they were 13%, they had 13% higher treasury exposure than any other bank in the US. Plus
right,
they had the longest duration, so whenever the interest rates went against them, they would get hit the hardest.
right.
So they, I
Uh,
mean, as
so they didn't have a CRO, and I just want to know that they kind of cruised through this time period while they were doing these. They were creating these problems with themselves. Is there an external factor that brought attention to the irregularities within the bank?
So some people were flagging, to their credit, some of these issues. I mean, obviously nobody thought that Silicon Valley would just go under. I mean, so when this SVB's income was being squeezed by this higher, uh, what you call, interest rates, uh, basically some Wall Street analysts were noticing. So what they did was, their president, like, sorry, I forget his name, like, his last name, Greg Becker. So Greg Becker, or sorry, what is it, maybe it was the CFO, I don't remember. He had a meet and greet with the investors over 2 hours last November, and he was trying to reassure them like, no, we don't have the issue, and like, if there was any kind of downturn, it would be manageable, and we had ample liquidity to sell the securities at a loss. But I mean,
Hmm,
mind you, this securities at a loss where they sold for a 1.8 billion loss is like what triggered the initial panic. So as late as January, even like other banks like JP Morgan had
hmm,
forecast a turnaround for the SVB, and was recommending to its own clients like JP Morgan.
hmm.
So, and like, I mean, this is like kind of hilarious. I mean, and not for the people who lost money in it, but like a week
Sure.
before the bank failed, in its annual report to shareholders, Silicon Valley praised its top executives for an area of achievement. And like, don't it, you might fall off with your chair by listening this, managing risk.
Hmm. Right.
And then they said that the
Is this
CEO,
blatant or is this just an oversight? Is this like something that they were brazenly trying to cover up, or do you believe that it's a more of
I
an
mean,
oversight and we shouldn't?
I guess like, I mean, it's hard for me. I mean, I'm not in the financial field, so it's hard for me to say it. But like, it looks like just like overconfidence. Like, I mean, even the CEO. I mean, the CEO had. Sorry, the report said that the CFO was credited for, and I quotes promotion of a strong risk culture. I mean, apparently that meant not having a CRO for 8 or 9
Right,
months.
right, right.
So I mean, it was just like crazy. Like, I mean, what was happening? I mean, but let's come to the blame game. Okay, so now there's a lot of blame to go around. So any, as with any like crisis, like, a big blame game starts. Eventually it becomes a little bit political and stuff. So once this bank collapsed, people on in Capitol Hill, like in Washington, they were blaming that. Okay, so like to give a background, what ended up happening is, in 2018, under the Trump administration, they passed new regulations to exempt banks from more strict oversight. So what they had said is, like, the old threshold was 50 billion, and
Mm.
they changed it to 250 billion because they said it's a very onerous, like all this oversight and paperwork, and it creates a lot of headache for the banks, and it reduces like the bank's capacity. I mean, uh, uh, the SUB president Greg Becker, he also testified in front of Congress, and he said, like, he pressed Congress to reduce the scrutiny because he said, citing the low risk model of our activities and business model.
Mhm.
So, and then the legislation did pass. So a lot of people are blaming, the legislation which reduced the oversight from 50, because see, like,
Mm.
uh, Silicon Valley had only like, let's say 170, let's say 200 billion or less. So even with the new regulation, it would be under the threshold of 250. Um, Also, like a lot of blame. So once Silicon Valley bank collapsed, the FDIC took it over, and interestingly, those 93% of deposits over 250K, they were also guaranteed. Now later on, it was like the Intercept, like a news portal, found out that basically Gavin Newsom, like the California governor, had
Yeah.
lobbied the White House and Treasury on the bailout, but he didn't
Mm.
disclose that he had private wineries which were the bank's clients, and then he even might have had a personal account at the bank. And the SB president Greg Becker was set on the board of his wife's charity. So it's all like a, like, in Hindi we say Mili Julie Bhagat. I mean, not saying
Yeah,
like Gavin Newsom profited from it, but like he had a vested interest in like making sure.
definitely.
I mean, it's like just crazy that there's so many connections here. I mean, even KPMG, I mean, they're supposed to do an audit. They gave a clean bill of health 14 days before the collapse. So, I mean, there are like red flags, but like everybody is like either like blatantly misled, or like, or like looking the other way to it. I mean, uh, so like always there were hearings on Capitol Hill once. So the vice chair of supervision, Michael Barr from the Fed. So he
Mm.
said that in end of 2021, they found deficiencies in the bank's liquidity risk management, resulting in not one but six supervisory findings related to the bank liquidity stress testing, contingency funding, and liquidity risk management. And in May 2022, the supervisors issued this three findings related to ineffective board oversight, risk management weakness, and the bank's internal audit functions. So there were red flags. Even Fed supervisors flagged it.
Mm.
But the million dollar, and I don't know, I mean, even only the Federal Reserve can answer why, after flagging it, it's like it's one thing to flag the issue. You
Sure.
want to flag the issue, you have to enforce it, right? I mean, if you don't enforce it, then nothing will happen, and it will just nothing will happen. And I'll even, and if you think like this was not the most incredible part of the story, hold on to your hats. So fast forward to Feb 2023. So the board of governors, and I want you to bring up that slide, they were given a presentation on the impact of rising interest rates. So there is one slide which specifically featured Silicon Valley Bank, and if you, I'll just wait for you to bring up that slide.
Sure.
So it said that, no, the next one. Yeah, so
Ah,
if you read it, this is actual what was presented to
right, right.
the board of governors of the Fed. It had significant interest rate risk, and that
Mm-hmm.
SBB's unrealized losses were massive, highlighting an existing loss of depositors even before the March 2023 run.
Yeah.
Now, all of this was known before the collapse. Like, this is
Mm.
Feb 14, so this is probably like, I guess, 4 weeks before the collapse. I mean, give or take, or maybe little over 4 weeks. And if you want to wear a tinfoil hat and go conspiracy mode, Feb 15th is, if you look on a chart, when the SVB stock started collapsing. So somebody internally knew that they were in trouble and was started to short the stock, which added to its long list of troubles. So all of this came out later. So when Fed Chair Jay Powell was asked in his recent FOMC meeting, like, he has a meet and greet after the interest rate decision. He said, like, why didn't you do any action? And he said, oh, I thought this was just informational. I mean, how ridiculous can it be, right? I mean, if you're shown a presentation where you actually name the damn bank and you said there is a significant risk, why was no action taken? It's kind of incredulous that such a thing could happen. Like, you are flagging the risk, you have a slide in a presentation to the whole board of governors. But I mean also remember, like, the SVB president Greg Backer, he was on the San Francisco
Right.
Fed board. So it's all like, I mean, so many internal connections. I mean, it just like reminds me of that episode we did back in
Exactly.
November, right?
SBF, right?
Yeah, like, I
No,
mean, it's like
yeah. You were
about
talking
like,
about SBF, right?
yeah, SBF and FTX, right?
Yeah.
There were red flags. People flagged it, but like, just because everybody knew each other, like, nobody wanted to take a harsh action against each other to just to ride the ship before something really major breaks. So I mean, this is just incredible, kind
So
of
I
like
think the
lack of
major
oversight.
keeps breaking, but once the news comes out, this is why I kind of asked if there's an external factor that made depositors aware of the risk. Suddenly, more depositors aware of the risk because the risk has been there since a few months. So, what kind of caused them to withdraw at the same time? And
I
it's
think
obvious that, yeah,
it's
one
like a
bank
herd
shows up.
herd mentality. I think it's just like herd mentality, and social media amplifies everything to by a factor of 100x.
Sure, that is
I
true.
mean, and then like, one last part of the story. So many Democrats, like Senator Elizabeth Warren, so she
Mm.
said that, oh, because we changed, because I mean, she's a Democrat, she's going to go against whatever Republicans do. So she said the basically, so what happened in 2008, because we had a solvency crisis during the global financial crisis. Some reforms were passed, called as the Dodd-Frank legislation, basically, which basically made sure that the banks were um, subjected to higher scrutiny or more checks. So what ended up happening is that in under the Trump administration, they increased it from 50 to 250. So afterwards, like, one of the authors of the original legislation, Barney Frank, he was asked that, could did the modifications could have prevented a SVB type of failure. So he said, like, he agreed with the, interestingly, he, like, who wrote the legislation to rein in the bank, said he agreed with some of the analysts back then that 50 billion was a bit too low because it created too much overhead for the banks, but he might have gone to 150 and not 250. But I mean, and also the interestingly, he sat on the board of Signature Bank, which collapsed. So it's kind of, he's on the both sides of the spectrum. He is not only sits on the board of Signature, but he also wrote the original bill, like 13 years, like, let's say 12 years ago. So he has seen both sides of the coin. Like, he wrote the legislature, and then he supported some modifications, albeit not to the 250 billion level, maybe the 150 billion level. And he sat on the board. So he argued against Elizabeth Warren, another fellow Democrat. So these both are Democrats, by the way, like
Yeah.
Barney Frank and Elizabeth Warren.
Right,
and
right.
and, uh, and he argued that the original Dodd-Frank rules were for systemically important financial institutions. Okay, so like really big banks. So there are, I think, I mean, if you go to that other slide, the GSIBs, like they call it, the globally. So the whole idea was to prevent contagion. Like, if one bank goes under, it should not drag. No, the previous slide, the one before. So what the
Jesus.
worldwide they have done is, like, these are the big financial institutions, and they are very systemically important, and they are kind of the, the proverbial too big to fail kind of bank. I mean, interestingly, one of them is, I believe, like Credit Suisse. which already has failed. So like keeping that aside, I mean this is a too big to fail list. So the Dodd Frank was to prevent contagion from happening. Like one bank goes, it should not like drag
Right.
everybody down. uh to so Like I said, like it do not have prevented a SVB tax. I mean, remember, 80% of deposits leaving. I mean, no bank is in their right mind is going to leave like 80% cash in their deposits. Or maybe let's say cash is a bad example, but let's say even if treasuries, they could sell it right away and get the cash, they're not going to have that amount of cash right away. So he pushed back on Elizabeth Warren, saying like, so it's becoming kind of a blame game. Like the Democrats, some of them are blaming Trump, then Barney Frank, who originally wrote the legislation, he's blaming like he's saying this is a, like a thing that he could not account for. He said like the Lord Frank, we could not write legislation that will cover every possibility, and he says it's more of a regulation that they should have identified the failure. So he's putting it kind of in the Fed basket, and then the Fed says, oh, we flagged it, but we never attempted it. So like it's just like kind of everybody's just blaming each other, and nobody wants to take the fall for it, you know.
But there is not going to be any accountability for this. Like we've seen it even with SBF, right? Nobody actually involved in the legislature that
Yeah,
allows for these things to
yeah.
happen, involved in the actual profiteering of these, uh, you know, fallouts, is not going to jail.
Yeah, I mean, yeah, I mean, I don't know if let's see if SBF goes to jail first, but yeah, I mean, it would be like unlikely. I mean, all these people are well connected; they might pay a fine and
Absolutely.
get away with it, you know. So,
It's very interesting now. There's a PR campaign for even the Theranos founder. So it's like you can do whatever and then you get away with it. It's the best
hmm hmm hmm
criminal sheltering system as long as it's
hmm
white collar.
yeah, yeah.
Yeah. Well, that's interesting. What's the next subject that
Yeah,
you?
so next what I wanted to touch is like the interest rate, money, the money market funds and the deposit rates. So like many people have brought up a question that, okay, so what amount of liquidity a bank is supposed to carry? So if you see here, the small banks, the cash as a percentage of total deposits is, I mean, if I'm reading the graph right, it's somewhere like around 10%, right? In this graph. So it's not like a huge amount
Right.
that I mean maybe like 7.5 to 10%, let's say.
Okay.
So they carry that amount of cash in the bank. So it's not like if 50% of the depositors show up at your door tomorrow, you're
Mhm.
going to have the cash. So what
Yeah.
the Fed, and this is like part of the new reforms post GFC, that what banks are supposed to do is there's something called LCR. Sorry, I forget the full form. Basically, they are supposed to have like high quality liquid assets (HQLA)
Right.
equal to 30 days of deposit outflows. So they calculate, okay, what is your normal deposit, day to day deposit outflow. You multiply it by 30, and that is the amount of like treasuries. You know, treasuries you can sell it right away, maybe get it sold in, let's say, 1 or 2 days, and then you are supposed to hold that much amount of highly liquid asset. But again, if you have 80% of your depositors show up at your door, you're never going to survive the crash. But anyways,
Mm.
so what ended up happening is like some people are calling this a bank walk or a bank run. I mean, we always heard the bank run, but what
Mm.
some people like Jim Bianco of Bianco Research is calling it as a bank walk. So what's happening is now that interest rates are uh, like 5% today, uh, something called MMF or money market funds, they buy, they have cash as holding, and they buy short dated T bills and notes as in their portfolio, and they yield 4 to 5%. So people saying, okay, the stock market is not going or real estate is down, I have a lot of people have cash on the sideline. So they are saying they have suddenly woken up post the SVB crisis, okay, not pre, that,
Mhm.
oh, I can get 4 to 5% in my uh, MMF, right? Money market fund. So
Okay.
my bank is going to go down. Why should I
Mm.
put it there? Anyways, they are shortchanging me. They are giving me 0.1% rate, or even ridiculously sometimes 0.01%. I actually have a snapshot of my one of my bank accounts just paying me 0.01%. But anyways,
Wow.
beside the point. So People have thought, okay, if the anyways the bank is not giving me anything, I have cash, I'm not investing. This is like obviously like people who are well to do, not every US individual. Why don't I invest it in a treasury? Even a treasury you could buy technically, right? A US treasury, because I mean there's very little chance. I mean obviously let's keep the debt ceiling aside, but there's very little chance of like US defaulting uh, theoretically on their debt. So why don't I buy US Treasury? I can buy a certificate of. I mean, in India we call it FD, but CD or a MMF, they'll give me 4 to 5%.
Mm.
So the other part is also like, remember, see, in 2008 there was no electronically assisted bank runs, right? I mean during the GFC, I mean electronic banking was quite limited then. So technically you had to walk into a branch, fill out a form, and withdraw the money. Now technically only certain amount of people can fit in the bank. I mean cram into a bank and withdraw the money. I mean there was a physical bottleneck on how much money could be withdrawn. Now I mean you have something called this, right? A smartphone, which you can withdraw money within a matter of seconds. All the money can be withdrawn. People have written software APIs where you can pull out the money even like faster than like what you can do manually. Social media, as I said, like rumors spill, so it will just amplify the bank run in no amount of time. As I said, like 80% of your deposits could go out. Now Fed does mandate, as I said, the liquidity coverage ratio. Sorry, I just remembered the
Right,
LCR full
right,
form,
right.
that you
Yes.
hold enough high quality liquid assets or
Right.
HQLA to cover
Yes,
cash
yes.
outflows for 30 days. But
Huh.
if you get hit with a bank run, you're just going to get. Now the other problem is this timing issue. So what happens is like a treasury, as I said, let's say if interest rates go up, the treasury might be valued less today, but eventually it is going to pay you face value, assuming no solvency risk, plus your interest. So eventually it's not like you're okay, like let's say it's Adani stock, for example, right? It crashes down. Most people think it will go up again, but some people might say, oh, it will. Let's say if it, what if it doesn't go away, or let's say Apple stock, it comes down, or Tesla stock, but it might never reach those levels again. But bonds, they will pay the face value eventually, right? So even though you are down right now, eventually you will pay. So it's not like that it's a solvency issue. It's just a timing issue, that eventually you're going to get all the money back and you can pay out the depositor. But the depositor is asking for the money today, while
Right,
my bond is maturing, let's
right.
say, years from now. So it's a
Yeah.
timing. So that's why we call it like the duration mismatch, that your liabilities and your assets are not matching up. Because in your liabilities, what we think is that all your depositors will stay or will be sticky, as they say, for a long time, till your loans come due. Because the thing is, my money could have been loaned out to person XYZ. Now if I come ask for my money, the bank might not have that money, right? It might be stuck in a
Mm.
loan. But maybe once the XYZ loan gets over, technically, I mean, I'm doing a very simplistic explanation, that money can be given back to me. But for years and years, but that's, the bank has to make an assumption that the liabilities or the deposits that they got are remain sticky in the bank, and they're not going to fly out the next day. Because if they are, then they are in a hole. And at that point, if you have to sell these bonds at a loss, it just creates a larger issue. Because then people say, oh, yeah, this bank is selling bonds at a loss, so they must have some big trouble. So let's dump everything, dump their stock, withdraw as much cash as possible. So this created like this creates a negative feedback loop, where everybody is just fleeing. I mean, banks had this kind of a zero rate interest environment, where you know 5 years ago they could say, oh, I'm paying 0.1% interest. The depositor bhagne nahi wala hai kya, what will he do? I mean, worst case, he will invest in some stock which is risky, or maybe real
Mm.
estate or some speculative investment. Today the investor will say, like, screw you, like, why would I give you stay with you for 1%? So the bank has to say, okay, I'll give you 5%. Then the guy might think, oh, you know what, Abhi, let's say you give 3%, for example, or 4%. Then the guy will say, oh, it's not worth the risk of going through the hassle of transferring to a money market fund or CD, right? But that incentive has to be incentivized to not move the money. Now the problem is, if what if the bank says, I'll give you 3 to 4% instead of 0.1 or 0.5%, they have to pay more on their liabilities. So it hits while the assets are still paying that old rate. Remember, like they bought all these assets years ago, where their
Yeah.
assets are paying much smaller amount, and now if they have to pay much larger in liabilities, they get hit on their net interest income. So basically it's like, they are going to, it's like they are caught between two very hard choices, like a devil in the deep sea. One
Mm,
is offer no savings rate, very little saving rate to depositor, and cost deposit flat because everybody wants to chase a higher
mm,
mmf or cd or treasury, or and then face a solvency issue. Or the other one is offer high 4-5% interest rates to their depositors, that वो भाग ना जाए, but then they get killed in the net interest income because their assets are still getting that 1.5-3%. But if they offer 4 and 5, so is यहाँ मरने वाले या वहाँ मरने वाले, मरना तो like they are screwed either way. So they have a problem unless they can make sure that depositors don't flee. So this is the problem that banks are facing. I mean, and see, like they got like almost like 4 trillion in new deposits since the pandemic, right?
mm,
So the thing is like, say, okay, let's say you get 4 trillion in new deposits. Technically they could lend a lot of amount, but there was not that much amount. So some reports say only 10% of it was lent out to other people. So the thing is, if you don't have the loans, what else do? You just like, probably like they were saying, like 2 trillion was funneled into securities
mm,
and bonds.
mm.
Now all those are like gone down like 5, 10, 15, 20% in value, depending on how long of a duration they chose. So they are all taking losses now. But now the bigger banks like JP Morgan, like, I mean, actually Jamie Dimon, their CEO, said that we don't want to buy long term treasuries. I mean, maybe it's like very wise decision in hindsight that they don't want to put a lot, so they are doing better. But like people like Bank of America, they have like huge losses because they went piled into treasuries. So the bigger banks, they're more well diversified. They don't have a one area focused client base, so they
Mm.
can avoid the losses. They can hold it to maturity. Today it is loss, but I will hold it for 5-10 years. Everything will come back because like US is not going to default in there. But the
Right.
smaller banks are going to be in trouble because they are going to have this deposit flight.
I just wanted to ask about this. Sure, we have the long term and the short term, but isn't, banking on the government one of the more reliable things to do in a good banking, in a country that's good for banking or monetarily, especially, it's something like the US. So it's not like, of course, everything done is risky, but still, one would imagine that there's a government interest in keeping these banks alive that have invested so
Yeah,
heavily
so
into.
that's what they did. Like, so with SVB and FRC, they zeroed out the stockholders and some of the bondholders, but they said we'll save the deposits because those are your voters, right? I mean, you don't want them to lose a lot of money, especially like some of the, especially when the SVB went down. A lot of the vocal VC crowd was like totally up in arms that, oh, Federal Reserve causes. I mean, they didn't even point any finger at SVA because they had money was stuck in there, but they were pointing finger. I mean, like, sure, I mean, Fed did increase rates quite a bit in such a short period of time, so there was bound to be some pain. But um, what we touched upon like more is like kind of a, like the solvency angle. So interestingly, SVB had one loan default ever in its history. So it was completely different from 2000. It was completely solvency crisis. Your
Right.
counterparty can't pay you, and then you can't pay your counterparty. Say it just creates a cascade of events where everything gets frozen. So what ended up happening here is like a liquidity issue, right? That people are asking for money. It's not like people have stopped paying you money, or your assets, which are your loans, they are like not giving you. I mean, till now they are still giving you money, but the thing is that it's just a complete liquidity issue where um, like people are asking for money and you don't have the money right now. So it's kind of a different issue. So when people say, is it the same as 2008? Yes and no. Yes, banks are failing, but no, because it's a liquidity issue versus a solvency issue. Up till now, you never know what happens in the future.
That's a scary thought, but hopefully that does not happen. So Okay, this
Yeah,
is
so
what you were
yeah, this is
explaining.
what I was explaining, that see, like if you look to the left of the chart, the money market fund rate and the bank deposit rate. So the bank deposit rate has gone up to like a measly what, 0.5%, while the money market fund is like almost like above. I mean, this is like an old chart from Jim Bianco of Bianco Research, but it was like 4.5%. Now some of them are paying as high as like 4.75. So there is a lot of incentive for people to move, that if the bank is not paying me enough, why should I leave the money there? I mean, like, why won't put it in like a money market? And these are like pretty big money market funds that they're not going to go under anytime soon. So
Right. Uh, well, let's go through a couple more charts. Um, sorry to wait. Just a minute.
mhm.
Okay, so I'm just going to go to the topics we've outlined, and
Mm-hmm. So
yeah, my question is more about the future of these banking systems because, uh, we can say these are once in a generation events, but we do see the US banking system being undermined at least every decade. And this requires government intervention, and those interventions are very unconventional, right? Sometimes you bail out the bank, sometimes you take care of the depositors, and it's dicey. So, as a yeah, how do you envision the future, especially cryptocurrency is not also very well regulated, and we had a massive failure there as well. So despite the innovation and the kind of freedom to experiment, it's also freedom to experiment with the money of your own citizens. So how do you envision the future for these banks?
yeah, so the banks are not going to go away anytime soon. I mean, since you touched upon cryptocurrency, I wasn't planning to talk on it, but I'll brief. The funny thing is that like Bitcoin, like the price has gone up, and even gold, like because those are the natural hedges against like bank fail. So as the more banks have failed, the
Right.
prices of these assets have interestingly inversely correlated. Like they have gone up, which shows that more people are fleeing the traditional banking system. But I'm not saying that traditional banks are going to go away anytime soon. They're all
Right.
they are going to stay here. What on the government intervention part, I mean, so government has like couple of uh, programs. I mean, they all come up with different acronyms all the time. I mean, so they had something what was called the discount window, where the banks could say, okay, my asset is, let's say, valued at 90 or 80% of the original
Mm.
uh, bond price value, give me some money against it. So they will give that asset to the Fed, and Fed will give them some money against like what is the present value of it. So this
Mm.
time around they started even another like called, like it's called BTFP, or like bank term funding program. It sounded quite funnily close to BTFD, is like buy the effing dip. So so uh, they just start this different kind of program. In that they're going to say, oh, don't worry, we'll give you even though your assets might be down 10-15%, we will give you money equal to the face value of the bond. Like it has to be like a highly pristine collateral, but we'll give you like full face value, and you can borrow the money for up to 1 year. So they will inject all kinds of liquidity and all kinds of programs, that because they know it's a liquidity or a timing issue, so they are just trying to see if the banks can survive this crisis for one more year. I mean, so coming to this, even like legendary investor Ray Dalio has said that this is like bigger than what people think. Like, it's just not a banking issue. He says it's a global issue, because like all sorts of like pension funds, insurance companies, they were all into this, buying these government bonds, in some cases like really long, a lot of long dated bonds, like what Silicon Valley Bank done, and which has gone down in value. So it is going to hit hard. I mean, so whoever has a liquidity issue, I mean, they have to sell their bonds that way. So it's like, you own a stock, right? Today you say, oh, I own Apple stock, I have like X number of shares. They have gone down in value by 10%, for example. I'm just making it up on the fly. But like if I have enough cash reserve, and if some, god forbid, there's some medical emergency, some family emergency, I can use the cash reserve to pay off all my debts. But if I have something which exceeds that cash reserve, and then I have to start selling my Apple stock at a loss, then it creates more pain, right? Generally, so it's something like that. Like these banks, if they haven't accounted for some of these massive bank runs, they are going to face these issues more and more. I mean, let's look at the SVB, right? 42 billion on a Thursday, 100 billion flies out of the Friday. I mean, just imagine, like, I mean, can you imagine during the global financial crisis, like 100 billion would just go out of a bank? It's like unimaginable to think, like, so like as Jim Bianco of Bianco Research said, we are in a new world of potential hyper speed bank runs. Like if you don't think that, you're not paying attention.
Right. I'm not sure how one can prevent a bank run. It's like it's almost. I don't mean it's technically similar, but it's like organized shorting of a stock, right? You can't. I mean, obviously there has to be a hedge against it. You know,
Yeah, so I
it's the
mean,
risk,
some
right?
folks have called for like outright banning of shorting like bank stocks, but I mean that gets to the free capitalist like impulses. Like, can you really do it? Or I mean, like the Fed might, in the long run, might raise the FDIC insurance limit. I think some people have said that raise it from the current 250K to 1 million. So to prevent uninsured deposit flight, because people might think, oh, only 250 is safe, so let me withdraw it. Or I mean, because let's say if you're a small company, I mean, you don't bank with a large bank, but you have a let's say 2-3 million, you run payroll every 2 weeks or a month, then you need to have a lot of money at the bank. Now it's very cumbersome if you had to spread it across 3 banks or 4 banks. Let's say if you have a million and you spread 250 at 4 banks, and uh, to just to keep your money not from falling at risk. So some people have recommended, hey, maybe you go up to 1 million, 2 million, 3 million. But then that gets to the thing that, oh, are you protecting the top 1% because you're protecting the deposits up to 1 to 3 million? So it gets, are you protecting the 1%, or are you protecting the overall, uh, like the reducing the risk of bank? And also the banks will have to at some point increase their rates and take some short term pain.
Right. Oh, got it. I think that answers a lot of questions. For the viewers, I know you would have questions. It's a very information heavy
Mhm. And
topic.
then also like couple of more points if I wanted to cover is, if you don't mind.
Sure, sure. I was going to ask if there's more points, but
Yeah, yeah,
yeah,
yeah.
there's a
So
lot
just,
of heavy
yeah, yeah,
topics that have been discussed. So I'm guessing
yeah,
that there would be questions. So if you could
yeah,
just comment your questions below, then Mohal and I will get back to you on some of the answers.
yeah.
So, sure, go
So,
ahead.
so yeah, one I think wanted to like is like what this is going to cause is like obviously like Fed is going to work out some mechanism where to prevent such bank runs, they will ask banks to hold even more I mean uh, high quality liquid assets, or like increase the liquidity coverage ratio, the LCR, maybe from 30 days to a higher amount. We don't know. I mean, it's like all speculation. But that also, uh, I mean, just to guard against bank runs. But what the problem is, like, what does the remaining banks think, right? So today, if you're a bank, you think, oh, if let's say 40 million billion is flying out the branch, let me hold on to more cash, more liquid assets versus doing it. So what that hampers is, if you are holding on to more cash, you have less money to lend it out. So what this is causing is the credit is drying up, to because you have more liquid assets to guard against bank run. So slowly this creates a negative feedback loop in the economy. Earlier the economy is slowing and we could have worse economic conditions and job layoffs. Now that's where the solvency part comes in. Let's say if you have way worse economic conditions, and we hope that it doesn't become much worse than what it is, but let's say if it does, then if the companies can't make their loan payments, then it turns the liquidity crisis into a solvency crisis. And already, like, you are hearing like anecdotal reports that companies are being turned away for financing if they want to expand their business, or if they want to renew a loan, or they're being asked to post higher rates, so they might put off, let's say, an expansion of the business, or they might not start a new business, or they might say, oh, let's say if it was like a zombie company teetering near bankruptcy, it might just file for bankruptcy, saying that okay, the new rates are doesn't make sense to just shut down the business. So it just creates a negative business because now banks are on guard, and businesses will, I think, slowly there's a credit crunch coming, which would create like uh which could potentially cause more hardship in the days to come. Yeah, and then one more point was that like the favoring of the big banks or the small banks. So I mean, this is this incredible exchange between Oklahoma Senator James Lankford and Janet Yellen, who is the Treasury Secretary. So after the failure of SBB, basically uh, he asked like Janet Yellen point blank that would because they backstop all the uninsured deposits. Those 93% people were kind of covered. So like, would it extend to all bank who would fail in the future, or it would just be limited to like SVB? But, basically like are you doing a preferential treatment? So Janet Yellen's answer, I mean, you should like go watch that video. It was kind of quite revealing. Said that the federal government would extend the privilege to trouble banks whose failure would have a profound impact on the US financial system.
Mm, mm,
So then further he probed like that so who decides it, like so that gets a interesting question. So we did list, we did share the list of the GSIBs, right? The globally systematically important banks, the GSIBs. So now it creates kind of a two tier structure, right? That if it's GSIB too big to fail, we are going to backstop it. But they don't want to create like a kind of uh, risk that if they outright say that we will backstop every deposit in the nation, it creates an incentive for bank managers or bank executives to act badly, because they know, oh, even if I do some risky trades, uh, I might not earn money, but the depositors will be made whole. So it kinds of a conundrum that you cannot backstop everybody, but you also cannot favor everybody. So then on when Yellen was probed, like who will decide like which bank is important and which is not, right? Because that's a very billion-dollar question. So she said, like Janet Yellen, that it was decided by the super majority of the FDIC board members, Yellen herself, and the president. So which means like you could just have rampant favoritism on like who is, no matter like who is the president, who is the treasury secretary of. So it's almost like you're favoring the the big banks because they're too big to fail, while for the smaller, oh, we might just let them fail. But I mean, that what creates is like the bigger four banks might gobble up the smaller banks and become too even more bigger. I mean, and politicians constantly complain, oh, there's like near monopoly in the banking sector. We can't make them bigger, but like you still give bigger preferential treatment to them, right? And many of these smaller banks, they serve local communities, which might, and they might not give the bigger banks might not give the same rates or the treatments from the bigger banks. So you have a kind of a chicken and egg problem, like who to protect. You cannot just backstop every bank, because then every bank president might just act like SVB president Greg Becker and just make risky trades, because he knows like, hey, anything goes wrong, the Fed is going to make the depositors whole, and all the way you also cannot deposit. So it just creates like too much conundrum. I mean, interestingly, one of the banks called Custodia Bank, and coming back to like cryptocurrency, so they said like they were dealing with cryptocurrency. So they said we will have deposits backed by 108% cash or liquid assets, and it was rejected by the Fed, saying unsafe and unsound. So this comes to the whole thing about, I mean, you can look it up, like Custodia Bank, like the Fed will rejected their application because it's so, because we cannot have the deposit. So it's kind of crazy that on one hand you have some banks holding too little of deposits as cash, and others, somebody proposing 108% of the deposits, and they are rejected as unsafe and unsound. So it's just like playing favorites, like okay, you deal with like cryptocurrency, so we will let you fail. Like, I mean, even Signature, which was closed right after SVB and which is not gained as much attention, was closed on a Sunday, and they didn't have any issues like SVB. I mean, they were in trouble, but not the kind of issues like SVB. And they were like simply shut down. And what was happening is their assets were sold to another bank minus the digital or the crypto assets, saying that, oh, this will be, we don't want them to be sold to a separate bank, we just want to let them fail. So they're just creating this playing favorites, like which banks will survive and which will not, which just creates like favoritism charges, overall. I mean, interesting, like, I mean, to end this discussion, I mean, like, Henry Ford once said that, like, and I'll just quote him, like, it is well enough that people of a nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning.
That's quite prescient, even though things were not quite as bad for him.
Yeah.
But that's a very interesting quote. All right, Mohal, thank you so much for joining us today. This was quite an intense discussion. Thank you for all the explanations and for the slides. For the viewers, I have linked Mohal's podcast below to give it a listen. It's got some of the best conversations dealing with current affairs. And I've also mentioned the name of the book that Mohal mentioned at the beginning of the conversation, Trillion Dollar Triage, which would make for interesting read if this is something that you're interested in. All right, Mohal, thank you so much, and see you next time.
Thanks, Agarika.